Hey guys, Sean here. The markets are in a bloodbath, the everything crash is here, while inflation is still sky high. We are witnessing in real time the horrible consequences of money printing, blowing up asset bubbles, and our economy literally imploding on itself. But as bad as things are, it might get even worse as the Fed continues to raise rates. Now, a common question I keep asking myself is how bad can things get? Just remember that back in 1981, when interest rates were raised to 20% to fight inflation, the market crashed by only 21%. But today, rates are barely 1% and the market has been beaten down by 17%. Now, this alone tells us that the economy today is flush full of cheap money and still high on leverage. Now, the Fed wants to take us all the way to 3.5%, which likely isn't enough to combat the inflation we are seeing, but even if it could, can we even reach that target in one piece? Now, it's harder and harder to believe Powell when he says the US economy is still strong. After all, a few months ago, inflation was supposed to be transitory, right? And in this video, we will dive deep into why a recovery won't come so soon and why we might be on the verge of a big recessionary crash. Now, there were 2 points in history where we could have reset the economy for good and enjoyed an organic bull run that might be less intense but last for much longer. However, when the Fed stepped in 08 and 2020 to save the day, it changed the way the markets function forever. Now, when you lower rates for too long and start printing money like it's going out of fashion, you are just kicking the can down the road and the coming crash will only get worse. And because of this, we truly have not seen the bottom of the market in 08 and 2020 because helicopter money and steamy checks were injected into the economy. Now, did it prevent a recession then? It probably did. Was it necessary? It could have been. But because of this, we really have no idea if the level of the stock market today really reflects its true value because there was never a bottom and a long recovery period. Especially in 2020, when the market just bounced back in 6 months as a result of printing trillions of dollars. Now, this means that there's really no solid resistance level that anyone can predict how far the market can plummet to if the big implosion happens, right? The S&P 500 has already gone under 4,000 and it's just as likely as to hit 3,500 or even 3 grand. Mainstream media is trying to downplay the crash to keep people still invested in the market, and many people still believe that a reversal could be around the corner. Frankly, that is possible. Anything can happen, but it might be rather unlikely. Now, the recent market crash was triggered by rising bond yields that went above 3% as a result of the Fed raising rates, and this could start a domino effect that might cause markets to tank even further. Right now, the predominant sentiment in the market is fear. Everyone is feeling it, myself included, and we are seeing the classic people waiting on the sidelines or pulling out of the market. Now, as bond yields start to rise, investors are beginning to realize that maybe, just maybe, the stock market is over leveraged and a big portion are thinking, the stock market is imploding. It will likely continue to hit down. Maybe I should run to bonds and be happy with just 3 or 4%. I'll take the inflation hit, but at least I'll lose less. And this could trigger a self-fulfilling prophecy. But if we look carefully, bond yields are still holding strong around the 2.8 to 3% level. And this shows that money is still waiting on the sidelines and isn't flowing massively just yet into bonds. Now, what is happening? And it's a real simple explanation. It's because the Fed is about to start reducing their balance sheet and start selling off their bonds to the market. Remember, the more bonds that are being sold, the value will drop and the yield or interest rate will rise. So investors are waiting for yields to really soar before they pile into bonds big time. After all, the Fed has already announced that they will start selling $45 billion worth of bonds every month starting in June and start scaling up to $95 billion a month by September. And they have up to $9 trillion to sell. And this means that the Fed has not just stopped pumping liquidity to the market, but is also pulling out money from the financial system. And this is the environment we are in. On one hand, interest rates are rising, and on the other, money is being sucked out. Now, this is good to help combat inflation, but in doing so, this achieves two deadly effects on the market, right? Now, firstly, bond yields will continue to stay elevated, and there could be more money staying on the sidelines, just waiting like a wolf to pounce once the Fed's selling of their own bonds reaches a peak. And secondly, there will be much less liquidity in the system from the Fed bond sales and when people start piling in. Now, this sets up a weird kind of liquidity trap. Less money around means there will likely be less risk taking and fewer odds of money flowing into stocks. And this puts pressure on stock prices. But investors who are waiting for bond yields to rise also can't wait forever in cash, as inflation will be eating it up. And stock dividends during a recession, which I argue we are probably in one right now, will be rather pathetic. So where will the money go? Some will be forced into bonds, no doubt, and the other direction will be likely to stockpile the essentials like food and supplies that will most likely guarantee an ROI on your money as prices continue to rise over time. And this just feeds inflation even further and increases the Fed's motivation to hike rates. See the deadly cycle that could be triggered, but just how bad can the crash get? Now, two things are impossible to predict and forecast when it comes to investing: an exact price and when it will happen. No one has a crystal ball, and anyone who says they can is either God or they're lying. But we can have a gauge of how bad the crash can potentially be, and we just need to look back in history. Now, the stock market is risk-taking and the bond market represents safety, so there's an inverse kind of relationship that we can track. Taking a look at the S&P 500 to bond ratio, we can see how overpriced stocks are compared to bonds. The higher it is, the more risk-taking the market is, and right now, we are near the top where the return for stocks is much greater than bonds. Now, obviously, this chart doesn't tell us when a crash will happen, but once a crash does happen, stocks will fall and bonds will begin to give a better return relative to equities. Now, the horrific thing is that sentiment can change quickly and suddenly when there's a rush to safety. And from where we are, it looks like there's still quite a bit of room to fall if this goes unchecked. And we can also double check this with the S&P 500 to gold ratio, where we compare the performance of the stock market with the price of gold, which is considered real money. Now, historically, the price of gold and the S&P have met at the same 1:1 price multiple times in history, especially back in 2009 and 2013, right, between that time range. And back in 2008, both gold and the S&P were at $850 together, right? So gold was worth $850 and one share of the S&P was also $850 as well. Now, currently gold is around $1850 and the S&P is at 4,000, right? Let's just call it 4 grand even. And that means if history is any guide, gold could increase and the S&P could decrease until they meet together, right? Or both can fall in price, but the stock market just falls faster until they meet. And this is terrifying because either way, if this happens, the S&P will definitely be lower than 4K. And the big question is how much it could drop. Now, history might not repeat itself and things could change, but this is something that we should be aware of as well. Right now, we are in a weird state of affairs where asset prices are imploding, but the essentials we need, food and fuel, are rising, but yet unemployment is low for now. And I think we all need to rewire our brains to accept the fact that this world has changed and we are in a weird pseudo-stagflation state, right? But more importantly, it is to disconnect assets from essential consumables and that not everything will rise in price together. The markets are imploding because too much money has been printed in such a short time, and people are all drunk cowboys speculating in everything from GameStop to NFTs. Just take a look at Bitcoin's chart and you can see how investing has turned into gambling at a casino and how many people are chasing the big one, right? That life-changing return. But on the other hand, food and energy prices are continually going up because of real-world issues such as the Russia and Ukraine war that doesn't seem to be stopping anytime soon. The breadbaskets are at war, causing further supply chain issues together with commodity shortages that are affecting us at the supermarket and the gas pump. Even fertilizer prices are up by 30 to 40%, and this will be passed down to the consumer, me and you, sooner or later. But what's really concerning is the move by countries towards protectionism, right? Countries like Indonesia are banning the export of palm oil, a vital cooking ingredient in our foods. And we can't really blame them as well. It's becoming every nation for themselves. But what if this extends to other food exports, right? What if countries that produce food decide not to export to countries that don't produce their own. And that's why, even though interest rates might go up and money is being pulled out of the system, the supply side isn't solved and might actually be getting worse. When it comes to this market carnage, you need to understand that when you buy an asset, doesn't matter if it's gold, silver stocks, or even collectible cards, it is likely to fall in price the next day. And you need to be okay with it, right? You need to be okay with buying on Monday and getting punched in the face on Tuesday when you check the price, right? Because if you don't invest, the inflation monster is still going to come for you. You cannot chase returns in such a market, and you need to have a mindset that you're buying up and accumulating assets for the long game. And I'm talking about 5, 10, or even 20 years. Now, if you want to build a substantial position, if you want to play this game in anything, maybe it's gold, maybe it's equities, or even farmland, you have to be willing to buy whether price is going up, trending sideways, or getting smashed down. Are you happier buying into a market that's going up and paying progressively higher prices? Or are you better off buying when a market is going down and you can buy assets more cheaply as time goes on? And there has to be a mindset shift if you want to stockpile assets without panicking, right? And this is where dollar cost averaging is the superior strategy, especially in today's market where everything is under pressure. You want to have some dry powder in case the market takes another big dip. And you might be asking, why don't I just wait for the market to drop another 20 or 30% before I start buying? And this is a very fair question. I cannot fault you for asking that. I myself have been asking that for weeks and even months, right? But the big problem is that you aren't clairvoyant. No one can see into the future. I can't even predict what I'm going to eat for lunch tomorrow, much less how the market will perform. And no one can predict the bottom, right? Maybe the bottom is next week, maybe it's next year, it could be even today. And the Fed has issued a liquidity warning, and they might use it as an excuse to U-turn their tightening and start reinflating the economy. Especially when the stock market today is already cratering with just 1% interest rates. We need to understand that interest rates are just one part of the equation the Fed sees. They have a dual mandate that includes keeping unemployment down, and if interest rates goes too high and stock prices go too low, companies might have issues raising capital and growing their business. And this means potential defaults and people losing their jobs if it's bad enough. And at that point, the Fed might just come swooping in like Superman to save the day with free money. At the end of the day, this crash is a perfect example of why the rich are only going to get richer and the wealth divide will only increase. It all has to do with the rising cost of debt and food prices, inflation in the essentials. Now, only asset prices are deflating, not food and fuel, and you can kind of know where I'm going with this. The majority of people who will not have enough excess money outside of survival to buy up assets, even though they're getting cheaper and cheaper. And that is the real tragedy. For many of us somewhere in the middle, we need to be smart about the things we buy and lower our expenses to buy assets, right? Stop buying that new TV and pick up shares in the S&P. Stop drinking Starbucks and maybe stack more silver coins. Go on a diet for all I care. We need to be extremely discerning about what we buy if we really want to purchase our freedom back. We all need to be buying more assets and not crap, because we won't know when we could get this opportunity to stack and hoard assets for cheap. Remember that after the crash in 08, the market went on a big tear all the way to 2020. That's an incredible 12 years of growth, and yes, it's fueled by the Fed's cheap money, but it's still growth. And things will stabilize, right? Markets will recover, and we always want to bet on human productivity and innovation for the long term, right? The human spirit will always trump, but if we want to profit, we need to have a plan to start accumulating assets, and the first step is to be smarter with our money. And if you are in the red and you don't need the immediate cash, just don't panic sell. Something tells me that the smart and rich money are averaging all the way down to build gigantic positions. But if you can't afford a loss, right? If you're fearful of a loss, sometimes the best thing to do is to do absolutely nothing and watch how this plays out. I'm sure we've all been through downturns, and we need to have prudence, bravery, and holding power. Now, this crash will define who we are as people, and if we are disciplined enough to stay the course and spend wisely, we can come out on top. And remember that there's still a lot of room left to fall, and it could definitely happen. But on the reverse, We won't know when the Fed might step in again. There's still a lot of uncertainty surrounding the Russia-Ukraine war, and the dollar as the world reserve currency is still being under attack, right? The dollarization is happening. So if you're buying into this market, lump sum investing with a casino mentality is maybe the worst thing that you can do. You need to keep your expectations in check and focus on accumulating assets, right? A lot of countries are now calling for a recession within the next 1 to 2 years, and it's becoming more of a reality. Many people are still in denial, but it's time to wake up and understand that this is just part and parcel of our new monetary system, easing and then money printing and then tightening and a crash and then easing and money printing once again. So let me know what you think. How much more can the markets tank? Are you waiting for more drops, or are you slowly averaging in and buying more assets? Let me know in the comments below, and if you enjoyed today's video, be sure to subscribe to my channel. Thank you all for watching, and I'll see you soon.